I know everyone said they did more deals, but I didn't see enough greed in the markets in 2023.
This is Jason Lemkin, founder and CEO of SaaStr, the biggest platform for SaaS and B2B founders in the world. I sat down with him and recapped the biggest events in venture in 2023 and placed our boldest predictions for 2024. SaaS early stage markets in 2024.
Yes.
What do you think?
This is the first year I'm worried. The deceleration that we saw last year, I'm worried some of it may be permanent. You could only spend so much of the global GDP on software. I think 2024 is the year of you might as well go public.
Who else is in the category of just do it, it's time to grow up?
I think there's some fun ones. The first one was
Jason, I am so excited for this. This is our first show of 2024, so thank you so much for joining me today.
Happy New Year, especially after just a banner year for unicorns and startups that was 2023, right? It's good to be back. Thank you, Harry. How many unicorns did we add last year? 1,000? 800 in 2023? How many new unicorns were there?
I mean, I'm thinking of a new joke for my next investor update, which is like 13 unicorns, of which 6 remain.
That's fair.
But that's a very confident start to an investor update. Listen, I want to start briefly for anyone that doesn't know or hasn't listened before. And before we dive in, Jason, can you just explain who you are and what SaaStr is? And then we're going to dive in.
Yeah, I was an early SaaS founder with the generations of Aaron Levy at Box and Renee Lessard and Drew Houston. And then I accidentally sold my company, EchoSign, too early to Adobe in 2011. And since then, I've been investing. Harry and I have co-invested in a number of folks and built this community called SaaStr that has the largest community in the world for SaaS founders.
Listen, love it. Now, I want to dive in and we're going to set the scene with 2 different parts to the show. We're going to do one, which is a review, and then we're going to do a predictions for 2024. So if we start on the review of 2023, I want to start with a view of optimism. What do you think was the standout / best company?
Well, look, I mean, there's only so much we can talk about OpenAI, right? But if literally they are, the funny thing about OpenAI is, if they ended the year at 1.4 billion run rate, at which the information said, and let's assume it was 100 million at the start of the year, then, we thought it was crazy when it raised at 20 billion and then it raised at 80 and then it fell apart, the tender offer. Now they're raising at 100. But if you can grow at those rates, I mean, every CEO I talk to at SaaS that's at scale, every public company CEO is like tired of talking about AI. But we didn't know if that revenue, I assume it is real. It's epic, right? It's generational growth of revenue, even if the gross margins may not be great.
Listen, I totally agree with you. The idea of scaling from 100 to 1.4 billion in ARR in a year is
in a year. Yeah.
Do you remember when we did our double?
I mean, it's the strangest thing.
Triple.
I mean, even my son found $20 a month to pay for ChatGPT, and I don't know where he got the money.
Okay, I'm going to give you an alternative.
Yeah.
I think Midjourney, company that's raised next to no money or no money at all, and now does I think 200 million in ARR. That's more impressive to me.
Listen, of course. I mean, OpenAI is the weirdest. I mean, we still don't even understand how weird it is, right? With a nonprofit running a weird profitable sort of thing with 100x return caps, with unpaid CEOs and engineers making millions a year that can do tender offers on a seemingly monthly basis. Here's the thing, Harry, you've been running, how many of these 20 VCs have you done?
2,938.
2,938. And the funny thing is, though, we all know as founders, VC is a tool, but, it's great if you never need it, right? That's your example. It's great if you never need it. It was so funny. Jam and Ball did a little workshop with us from Altimeter. Is like, listen, we really want to fund companies that don't need our money. The problem is we'd be out of business. So it's a fine line. Like, we don't really want to fund the companies that need us.
If you were to go to traditional company land and say a best company, I don't think enough is spoken about HubSpot. I think the continuing dominance of HubSpot is just phenomenally impressive.
It really is. I think it's impressive also because people today don't even remember the old HubSpot, the HubSpot that got going the same time I got going. This is probably 2 generations ago as a founder. This was a blogging company. This was a website grader and blogging company. And if you use HubSpot, most of us use HubSpot. If nothing else, we use it for marketing automation, right? For sending our customer community. That was even part of the original product. right? That wasn't even part of the original product. And then the fact that now they're doing 700 million, their CRM product, their CRM, which is the first real threat at least to the low end of Salesforce we've ever seen. It's super impressive, right? It's super impressive on many levels. And my big learning is, if you really want to take the takeaway, it's this is what I learned talking with. I mean, you've talked with them as well, but when I got to interview Brian and Dharmesh, the co-founders, together, the one thing I really learned was really going long. And the fact that Dharmesh had already had an okay exit, right? A $100 million or $80 million exit. And that they both from day one are like, listen, we're going to build something big, or that's it, right? We're going to go long. And so I met Dharmesh in 2013 or 2014 when they were thinking about CRM, right? And they'd met with Pipedrive, which was my first venture investment, right? Which eventually sold for $1.5 billion, but lost to HubSpot. Interesting story. Pipedrive lost to HubSpot. That's how I met them. And the fact that they were willing to go so long, spend years with the free CRM, even though it was going to detract resources from the marketing side, right? It has to detract resources, and wait. And now that they're coming up on 700 million, it's one of the greatest second acts, and HubSpot really has 5 clouds, but it's one of the greatest second acts of all times because there's almost no synergy to the first act.
I remember Satya and Hunter at Homebrew saying actually one of the joys of their partnerships was neither really needed the money, honestly, coming into it. And It actually meant they had a lot of mental and creative freedom around decision-making and purity around decision-making, which one wouldn't have if it was really about the money in a lot of cases.
Yeah, money's complicated. Brian did an interview recently where, he actually did sell a bunch of his stock pre-IPO, I think, to Sequoia, and he said it was the most expensive decision he'd ever made. So we need a little bit of money. It's never quite that simple. I actually think that I'm not sure if in venture, if not caring about money is a positive. I'm not convinced. I think it has some positives at the pre-seed stage, right, going into seed. But I really think to go long in this business, you've just got to bleed money. You've got to want to put the zeros and ones in your bank account, or what's the point? What's the point of venture after a certain phase? If you're a pre-seed investor, the founders forget about you when they get big. You get dropped off the investor updates, right?
Isn't it a deep insecurity to prove yourself? I find the ones that do overly optimize around money downside protect a lot. They continuously worry about portfolio management, selling positions early. Now, maybe in the last few years, that might have been a good thing. Maybe I look at mine and think I should have done. Yeah. But fundamentally, upside maximization is our game here. Holding on to HubSpot, holding on to Shopify. And when you don't really need the money, we both have friends who really do not need the money. They just go, I see what Jason sees. I believe in this. Yes. In a way that one wouldn't if you needed it.
For sure. I think there is a category of lifer VC with no other opportunity that are mediocre investors that can be inadvertently toxic. They can be so focused on the downside. They need their $1 million salary. There's nothing. They have no other possible career path, and they have no savings, right? So those folks, I think, are the most dangerous. Are
there many of them?
What's that? I've worked with many, and they're especially frustrating in exit scenarios for the reasons you say, right? But I think the problem, actually, the folks that I know of founders that are too rich that got into venture, it's a problem. Let's say, Harry, you were lucky enough, you sold your company for $1 billion. You made $200 million, okay? And you put it away. And actually, last year was pretty good on NASDAQ. So last year, you made $40 million in the stock market, and you raised an $80 million fund with 4 of your friends. So 5 of you are splitting an $80 million fund. What's that? 16 each, right? And after a decade, you do 3x gross, which is still pretty good. Like, it was terrible in 2021, but it's pretty good. So let's do the math. The 80 million, 3x growth, 240. Let's call it, what's the gain on that? 160, but let's take out all the fees and all that. So the gain's what, 100 million, right? Over 10 years divided by 5 partners. That's 20 million each. Over 10 years, that's an extra 2 million. Now, 2 million is a lot of money a year, but it took you 10 years to get there. You had to, and he made she or he made 200 million on their exit, right?
And compounding 10% annually in stock markets and liquid vehicles.
So, and what's interesting now that I've learned, at first I thought being too rich was bad for venture, but now what I've learned, it took me a little while to learn it. Now, if you're too rich in venture, you just have to raise billions and billions and billions. That's the only way. It's like, and David Sachs, who I have a ton of respect for, he's raised almost $4 billion for Kraft since I started investing, right? So, but why? I mean, you've got to be impactful at that level, right? You've got to, or Andreessen Horowitz. It's not as silly as it sounds, right?
Okay, I'm just shooting from the hip here, but I had an LP email me this morning and said, of the multi-billion-dollar funds, which one are you most confident will do a 3x net?
Yeah, I wish I had the data. I get intimidated by the raw math of what it takes to turn billions dollars fund into 3x. It's just so many decacorns you need.
I said one answer. I said Founders Fund, and I said it because of something that Brian Singerman told me, which is like, we are unparalleled in the willingness to have extreme capital concentration on a per company basis, which means we could lose a lot. But if we're right, we do get the same upside that a smaller fund would get because of the concentration we have. And so I would have Founders Fund as mine. Who would you have as yours?
I don't know. I usually have a pretty good answer. I think that's a good answer. I mean, Founders Fund, I haven't seen the returns in a while. The returns from some of their bigger funds were epic, right? Were jaw-droppingly good. So I think that's a good bet. I can't say I've seen too many other funds of scale that have those sorts of numbers, so I'm not sure.
Okay, we're going to move on in our awards ceremony from best company to best founder. Whose standout year was it in 2023?
I mean, how could it not be the CEO of NVIDIA?
I agree. I mean, Jensen is busier than ever.
How can you not have, after all these years, gotten to $1 trillion market cap and recognize that there's nothing harder on planet Earth than being a founder in the same year? And really just recognize the no bullshit, no... This is why, Harry, you've done, how many of these 20 VCs again?
2,936.
This is why I won't even talk or interview a founder below 20 or 30 million in revenue, because they're not honest enough. They don't have enough life experience, right? To hear from NVIDIA, which, has been in a ruthlessly competitive market with non-recurring revenue, right? Live or die on these margins, finally become one of the breakout top 5 tech companies of all time and say, I wish I wasn't a founder. Not literally, but conceptually. I mean, I don't know. It's got to be founder of the year. Talk about going long, right? Talk about going long.
Sorry, I am interested. You said that you wouldn't speak to founder beneath 20, 30 just because of the lack of wisdom or experience. What do you mean by that, Jason?
They're always just selling themselves. You want to hear, when you talk, especially if you're doing an interview or discussion, you don't want to hear what's great about NVIDIA. You want to hear about the mistakes. The mistakes are what's compelling in any journry, right? Yeah. The mistakes are what's compelling. We talked a little bit, or some folks talked about whether that Bezos interview the other day was compelling or not, right? I actually thought it was pretty good, but the problem with it is there weren't enough mistakes discussed, right? That's what's interesting. And I find that founders below 20 or 30 million, all they can do is do a commercial. All they can do is spew a commercial out of it. And 20, 30 million is pretty far from a founder perspective, right? I used to think 20 to 30 million was a lot of revenue until I remember talking to Todd McKinnon, who's CEO of Okta, and he said it wasn't until 30 million that he thought they couldn't be killed, that they weren't an early stage startup anymore. And I used to think that was later in the journey, right? And it was an insight. And it's also about the same time where you can start being honest and say, here's what I screwed up building the 20 VC fund. Here's what I screwed up earlier in my career. Here's what I screwed up in NVIDIA, versus I'm the world's best compliance software HR manager company in the world. No one wants to hear that.
No, listen, I agree with you on Jensen. I'm going to throw one hat in the ring also for Brian Armstrong at Coinbase. I just think, given the volatility of crypto, the man is just an unwavering force of strength in the community with CZ, with SBF, with everything that he faces. Regulatory, he's standout. He's a standout leader. There's so many things also that he's said. He was killed for the no politics in Coinbase. Everyone now is saying, yeah, we agree, no politics in Coinbase.
I'm not with you on this one, Harry.
Why? Hit me.
I believe every crypto company that has an earn program is a fraud. How can you pay these interest rates? But I'm looking at their website today. I can get 10% APY on my crypto. 10%. How is this possible? It's called fraud to me. So when I hear someone's a good one, and I remember I didn't know anything about Binance, and people back then were saying it was the good one. And I looked up in their earn program when interest rates were 0, was like 18%. How can I get 18% interest when the Fed was at 0, right? And even, I know Coinbase is the good one, but where are they getting this 10%? It's a pyramid scheme. It's fraud. So I admire the fact that they are complying with some regulations. I love the marketing. I think the marketing positioning is genius, right?
Can I just ask you, you said before we move on about sales and marketing efficiency falling through the floor, and can you just unpack that for me and how you analyze that?
The average public SaaS company was up 41% last year, even though growth plummeted. Growth was at all-time lows in SaaS, all-time lows in 2023. The average public SaaS company only grew 16% last year. It's terrible. But the stock was up 41%. These are weird datas, right? These are weird data. And not only did growth plummet, but stock prices went up. And the reason is likely efficiency, right? Everyone got so efficient. They got so fit. And they cut all marketing spend and they froze hiring, right? There was a lot of PR about layoffs, but layoffs are a much smaller story than just freezing hiring. Freezing hiring for 2 years is essentially sort of like a layoff, right? If you grow 50% in over 2 years and headcount's flat, then you basically didn't hire that extra 50% of people. And so weird world where just being in public cloud stocks was great. Growth was terrible. But what happened was all that growth came from the base. It all came from price increases. It all came from pushing customers to sign long-term contracts they didn't want to sign. New logo growth was very low. And so what happened was this weird world where sales and marketing efficiency, CAC, were at the lowest. CACs are at the highest they've been in my lifetime as a founder that we know of. It cost the most to acquire a new customer last year because we sort of hid in our existing base. So we're in a tough world in 2024, which is we all got fit. We all got efficient. We all made those venture rounds stretch, right? Every unicorn that can't raise again, if they're not going under, they figured out how to at least grow a little bit with half the head count. But how are we all going to get back to growth? That's the story for 2024. How are we going to get back? And everyone's hoping it's AI, like I'm going to put some bots on my website and that's going to create growth. I think AI can create some efficiency, but growth, let's see if it can create growth. I'm skeptical it can create growth, right?
Has the time come of get back to growth or still in survival mode? I speak to a lot of founders who think that we're still in survival mode of just batten down the hatches, survive and wait until the good times come again.
I think we're absolutely there. And I think I've invested in 6 companies at the pre-seed stage that are now north of 200 million. Okay. And so they're IPO candidates. Okay. And most of them, not all, I mean, I'm not talking about hundreds, so maybe most is the wrong word. I would say a bunch of them are on the bubble. And what I mean is they're all cash flow positive now, all of them. Everyone got cash flow positive, okay? Because you had to, because the next round wasn't going to come. It actually wasn't that hard. You just paused hiring. Most of them didn't do layoffs. You just pause hiring and you get cash flow positive in SaaS at that scale at 200 million. But the question is, they want to go IPO, and I've got $70,000 with you that there'll be 26 IPOs next year. I think I may have been off by 6 months, so I'm going to lose. It's okay. But the question for these folks is they are back to growth because they have marginal growth now. They have marginal growth. And no one wants to IPO at 4x revenue or 5x revenue. And so, yeah, they're fit and efficient. But instead of growing 40% and losing 20%, maybe they're at 20 and 0, right? Or 20 and 5. And so, yes, people don't have here's the stressful part. People don't have the answers in 2024 about how to get back to growth. But the good ones are there. You went on the diet and we hit our target weight, Harry. Now we got to pump up. You know, I mean, you're a fitness guy. Now we got to put on muscle. Like we cut, and then after you cut, you got to pack on the muscle, don't you?
Do you not just wonder if this is a good business? And I don't mean to be depressing in that way, but entry prices are as high as ever, I think. Like if you have great quality SaaS founders or repeat founders or coming out of any blue chip, they're as high as they've ever been. They haven't been depressed pricing really at seed. Maybe in some cases 10 or 20% down, but not significant.
No decline, really.
Okay, no decline. But then we've seen this compression in terms of exit scenarios in terms of sizing and pipe dramatically to 4 or 5x. Does venture even make sense as a business in that world?
Well, it's funny. If one of the questions you'd asked me was what was the most impactful tweet you saw last year on venture, right? Yeah. And I'm going to completely misquote this and get this wrong, right? But Bill Gurley had the one about how the way venture works is you just wait for these little periods when you can actually make money and get exits. And you got to sell all your winners or take them public in these little windows where there's bubbles, where there's 20x, 40x, 50x ARR, like 2021, and you really can't make money in venture outside of these windows. Was kind of, I'm misquoting him, but that's what he said, right? There are these windows where you make money in venture that really, it hit me kind of hard, right? To your point. And I'm like, it doesn't feel like in the beginning of 24 that venture is a particularly easy industry, does it? It feels pretty hard, right?
No, but it was never meant to be easy.
No, but at least when I started in 2013, the exits were terrible, but the entry prices were lower, right? So I didn't actually, when I started investing, I didn't think I would be any good, and I didn't think I'd have any great returns. But I thought everything I did would make money. Every investment I did when I make, just because the entry prices were acceptable. When I invested in Pipedrive in 2013, my first investment, it was 16 pre at 1.2 million ARR. Okay, growing 9% a month. Okay, and we argued over the price. Now, pros and cons, but it did exit for $1.5 billion. So if you got in at 1.5 million ARR tripling at 16 pre, you were going to make money, right? You were going to make money. Now it's stressful because I feel like most investments I make, I'm not sure they're going to make money. I do wonder, going to Bill Gurley, if we're all just waiting for these windows. We're all just waiting for these windows to swing back, these 12 to 24 month periods of hyper liquidity and hyper multiples. And because of that, honestly, I was reflecting on this deeply. I've changed my mind to founders. I think some of the worst advice I've given to founders is when to sell their company. When I look back on 10 years of investing, 11 years, I've given bad advice on when to sell your company.
What advice have you given that you would like to have changed?
The advice I've given them is I made the same mistake so many founders turn investors do, is I give them the advice I learned, which is if you have something good, if growth is high, if burn is low and NRR is high, never sell because you keep adding value, right? If you're at 10 million ARR growing 100% with 110% NRR, then next year you'll be at 20 and then you'll be at 40 or 38 or 72. And that's how you build a decacorn. And so what tends to happen is just as it gets good, you get a couple M&A offers, right? And so my advice to founders has always been don't take it unless you're worried, like unless you can't do it, unless you see the industry shifting, unless your team isn't good. But you might as well go long because that value keeps compounding. And that's what I saw in my space. But now I see so many founders that said no to offers in the 2020 to 2021 period that will never get back there and will have to work a decade to get to lower exit values. And now the Bill Gurley thing resonates. Like if you get a good offer and it's in bullish times, take it. Take it, because it may be a decade. I think we're going to see 2021 again, and maybe AI will bring it back faster, but it could be a decade until we see another boom of that level.
Listen, I totally agree and get you. Okay, we're going to move on in our Oscar ceremony. What's the best early stage fund 2023?
Jeez, I need your help. You have all the folks. These are tough questions. The best early stage fund? Look, it has to be Y Combinator. Gary Tan coming back to Y Combinator. Was that the beginning of 2023 when Gary came back?
Yeah.
Talk about right person, right time, energy, rebuilding the entire city of San Francisco. The energy that Gary has. I remember the first time I met Gary, I did one of my first co-investments with him. I didn't even know who he was, but the power of his passion, his intelligence, and his incredible commitment to entrepreneurism, right? It was next level. And the fact that the weird thing when I first met Gary, which was probably 2013 too, maybe 2014, the weird thing back then was every founder loved him. Not loved him like, oh, that's a good guy, my buddy, whatever. He goes surfing with me or whatever. No, they just felt like Gary was the one that had their back. Not one, but every founder I met that Gary was an investor in thought Gary had their back. I don't know how you do that. That's not me. Founders that I've invested in will tell you that I deeply believed in them. I was the one that believed in them and did all this for them. But you can't find 100 people that said that would love me like they love Gary. However he reboots Y Combinator will add an order of magnitude of value to this organization. It's however much this story might have, as important as it might have been overlooked by OpenAI and all this other stuff, because YC is. It dominates this accelerator market, right? It's logarithmic distribution in terms of returns here, right? Making billionaires. And then it leveled up. That doesn't happen in venture. They all wind down, or generational transitions are hard. But A plus 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 getting Gary to run Y Combinator, and leave initialized. Leave a, what did he raise? $1 billion and had a top 10 fund, right? On many levels, right? I don't know, at least
And
initialize two.
Leave a firm you founded. Like
Initialize one's like 50x tiny fund, maybe 100x, and initialize two, I bet is 10x net for a big fund. I don't know the other ones, but to leave that, if you ask most VCs, they would think it's crazy. Why would you leave that cushy job of managing billions with top decile returns to go be CEO of something that you didn't even start?
Yeah.
Because he's probably not the boss. I love Gary. Yeah, and there's none of my business, but I think he had such passion for this. He loves Y Combinator. He said YC made me, right? But he didn't start it. So to go from something like Initialize, which you start, right? You are the managing partner. You are the director that he built, to then run something you didn't start. Like that's pretty epic for everybody. So it's got to be the quiet venture story, right? I would, if I could, it's just, I see at least another incredible decade for YC. And this was a genius move.
I agree with that. I would throw one other hat in the ring, and I don't know which, if they're early or late, you could put them in either one bluntly, but I don't think enough is talked about Kleiner. When you look at what Mamoon has built with the renewed Kleiner, the team is stellar. It's stellar from him and Ilya, but also, you've got Bucky, you've got Annie. Generational transition-wise, they really tick the boxes, I think. When you look at the portfolio, they have absolutely smashed it in terms of building a phenomenally exciting early-stage portfolio with great ownership positions. And I don't think that's given enough credit, actually.
I view Mamoon as, and this may not be, it may be the wrong term. When I think about a traditional fund and a traditional investor, I think top 0.1%. Mamoon goes in and it's like, it's going to be Slack. It's going to be Figma. It's going to be whatever. It's going to be Rippling. And he knows the playbook, and he doesn't bend the rules. He doesn't lower the standard because he didn't get a deal done last quarter. He doesn't do it for the fees. And if it's just a smidge below the bar, he don't do it. And he's a heat-seeking missile. And if that means, and I remember when I started investing, I would do a deal and Mamoon would be like, oh, can I meet them next week? And he would mark the deal up if needed be, right? Not that he didn't care. He's like, okay, if there's a 100x opportunity in Slack, it's fine. It's fine. And most folks don't have the ability to understand which one's a Slack or Figma, and they don't have the confidence to do that deal. The only thing I would say is I don't know. I think he wants to perfect the art of traditional venture capital, right? A small number, not this ultra concentrated thing, but a small number of just every year being in a couple of the best, right? But I don't know, has he 10x the amount of capital that Kleiner manages? Probably not, right? Has he 100x'd it? I don't know that he wants to build an Andreessen or a Bessemer or something like that, right? So the odd thing in venture is if you stay in your lane, it's the best way to achieve returns for your LPs and everything. But there are a lot of pressures to not stay in your lane. There's a lot of pressures to not stay in your lane.
I think Maritech would be another example, though, of an under-discussed but hugely successful franchise, which have stayed in their lane and delivered incredible returns.
Incredible returns, yeah. But, where is your ego? What's your id? What's the point of all of this? It's hard to stay in your lane.
It totally is. I think Jeff Lewis at Bedrock as well. When you actually look at Bedrock's portfolio, the dude's in Rippling, the dude's in Vercel, the dude's in Flock Safety.
Yes.
He's continuously he's in OpenAI. I mean, he's invested consistently in an incredible base of companies. And actually, with partner turnover, I think he's just done an exceptional job.
Yeah, for sure. The meta question is, though, for some folks is, what are we building? What are they building? Like, I think I know what Gary's building at Y Combinator, right? I'm not sure what Mamoon is. If I'm great. He helped me. I think he's one of the best. I've recommended him on the cap table many times, but I don't know what he's building other than a great fund, which is a lot. Bedrock's pretty interesting to watch from social media, right? Being not a VC. But Mamoon wasn't really a founder. He's been a lifelong A+ VC since the beginning, since he was an associate, right? He crushed it at USVP. If you're a bit of a founder as a VC, you have to think about, what am I building? What am I building and why? Builders got to build. VC used to be a place where founders would retire, but it's not true anymore.
Listen, I totally agree with you. The question is then, like, how open are you to tell the world about your vision? I often think this about what we do, which is like, you know what we do, and you know there's a lot of things that we do. I don't think people think about that often, and often put us in a media bucket or a podcast bucket. Sometimes I'm like, fine, underestimate us.
Yes.
And then other times I'm like, no, we should be doing more. We should be telling out our vision so founders know what we're building.
Look, there are many, there was something on Twitter today with Honam from Altos Ventures, incredible returns, right? Saying how they do, outside of his closed Twitter, they do no PR, no this, no that, right? So you can have great returns and literally intentionally have no one hear of you, right? I think that especially if you're pre-seed to seed, it's work. It's work. It helps if people know of you. It helps to have high awareness. It helps with a bunch of things. I think if you're later stage and you just cultivate relationships with the folks a stage below you, maybe. I mean, when we did the fun one with TCV, right? And
Insight.
Yeah, Insight. It was interesting that what is it, Woody from TCV is like, we don't PR. I mean, TCV is tracking every company that's 24 months from IPO and 24 months after. It's a confined universe of 1,500 companies, and they go meet with them.
No, it's a different world in that way. You mentioned TCV there. A tough fucking last 12 to 18 months for any late stage fund. What do you think is the best late stage fund, Jason?
Boy, I feel like a bad guess because I don't know. So much has changed the last 18 to 24 months, right? That I don't really, I'm not sure I know the answer. I'll tell you why I don't know the answer. If you take AI deals out of the equation, I think in 2023, very few deals got done north of 200 million valuations. Very, very few deals. Now, they're inside-led deals, right? And inside-led deals have their own dynamics, especially if the companies are doing well, right? If I already own 20%, and I'm a multi-billion-dollar fund, I might as well put money in at 600 or 800 or $1 billion for a whole host of reasons. But I didn't see a lot of, with the average public SaaS company trading at $2 billion, I just didn't see a lot of outside growth investors rushing to do deals north of 200 unless it was a bargain. I had portfolio companies where, all the late stage guys would come in and they'd want to do it at 5x or 6x. And we'd be like, well, yeah, but we have 3 years of runway. I don't need your down round because we don't need it. Like, so I saw a lot of tire kicking in 2023 post 200 million, but I only saw aggressive investing up to about 200 million valuations in my little ecosystem in SaaS. Just because I think people got intimidated that how are they going to get their 10x? How am I going to get my 10x if my comp's trading at 2.1 with dilution, with several rounds of dilution in IPO? How am I going to get my 10x? Like,
so who would you give best late stage fund to, Jason? You got the award.
Oh man, you're mean. I don't know. Honestly, I'm embarrassed. I don't know. I don't mean to be a bad guest, but I should have prepped more and looked at the charts because I don't. All I saw was a lot of. I know everyone said they did more deals. I know Iconic said they were way up, and Excel said they were back, and Salesforce. But I didn't see enough greed in the markets in 2023. I didn't see greed return.
What would you say is the biggest surprise that you saw in 23? What, when you looked at your phone, were you like, holy shit?
The biggest surprise I saw, this is a tactical point. I was very surprised that huge funds were not supporting their companies in up rounds, good rounds, that were very, very good companies, but not necessarily decacorns. I was surprised. I grew up in a world where big funds, if you doubled since the last round, tripled your revenue, right? And there was an outside lead or whatever lead, every big fund did their pro rata or they came close, right? I've got $3 billion under management. I did 10 million in the A. I'll do 2 million in the B or 3 million in the C or 4. Like, I never saw a big fund not do this. And then I watched a very good deal where a multi-billion-dollar fund said they're going to do 0. And I didn't call the partner out, but I asked him what happened. He's like, we're just very particular. We're generally not doing our pro ratas now. I've only done 2 or 3 recently. And that is a level of conservatism that doesn't make sense to me, right? On a bunch of levels. It doesn't make sense to me as an efficient way to deploy a large fund. And it doesn't make sense to me as a good long-term play. And it doesn't make sense to me as something that will improve returns, right? There are a lot of reasons to support your portfolio companies, right? And there are plenty of reasons to not support your dogs, your losers, right? I mean, that you have to be careful there. But anyone in the top quartile should get another check from a big fund. And so the fact that that wasn't happening, I think it was fear they couldn't raise another fund. I think maybe it's fear that they'd written too many bridge round checks. I don't know, but that was my shocker. Was these automatic pro ratas appear to have gone on pause.
In the time frame where reserves will be deployed, do you think your winners and your losers will be apparent? Like often it's traction investing in the world of consumer where it's like, oh, we hit X number of DAU or MAU. That's not sustainable. And then if it's SaaS, often it just, as you said, going long, it takes just a long freaking time. Yeah, they scaled, grew double, but it's not 5X growth. And sometimes it's not obvious.
It's not. I do think that the sheer number of unicorns that were born in the work from home boom broke reserve models. So I think you have 1,000 unicorns, fine, 200 of them are going to die, right? 100 of them are going to break out. But what about the ones, Harry, that, hey, they're at 16 million ARR, but they're growing 80%. Now they're not worth 3.2 billion like they were in the last round, but they're growing 80% at 16 million. I'm already in. I own 18%. I got to do some reserves for that one, don't I? And the sheer number of them and the fact that they're not going to get another round when the last round was at 2 billion, I think blew up. Like I think the reserves for the middle corns, the reserves for the overvalued broke a lot of reserve models. And so everyone was like, I just don't want to, like, I'm going to run out of reserves, Harry. It was not how I planned. I'm going to run out. So I'm going to say no to even winners if I can get away with it, right? Because I may need that $2 million. Even in my big multi-billion fund, I may need that $2 million for that unicorn that's struggling.
For founders listening, what happens then? No one takes pro rata. No one does their reserves.
Yes.
What happens in that world then? Founders come out into a new environment and have to reprice? Because it's very difficult saying, hey, very few existing investors are coming back at all.
Yes.
It's a very difficult message.
Well, look, a couple things. First, one, be honest. Forget about what your existing investors want to do. First of all, you have to be honest. Are you fundable, right, at the margin? And you've got to ask honestly. Ask at the end of each board meeting, am I fundable? And then you ask afterwards, would you fund me? You don't have to put everyone on the spot. Just go around the table, am I fundable? And you won't get a completely honest answer, but you get a pretty honest answer, right? You'll get a pretty honest answer. And so if no one thinks you're fundable, then whatever you got in the bank is got to last, right? But what I have seen, then assume you're at the margin. Assume you're fundable-ish. Okay, you're not OpenAI, but you're fundable-ish. What I have seen in especially the last 24 months, but across my whole career of investing for 11 years, is there's usually only one investor that will stand up for you. There's usually only one. And I have had to do 3, even though I have a pretty efficient portfolio, I've had to do 3 of these in the last 14 months. And often I'm the smallest fund on the cap table. I've had to be the catalyst, the one that stands up and say, look, you're at 30 million growing 90%. That's not bad. Okay. I will put the money in. And if one person is a catalyst, generally folks that are humming and hawing and that are waiting, the catalyst can force them to shit or get off the can or S or get off the can. And that's how you coalesce the round. So as founders, you got to know who's the one, not the backslapper, not the one that always says, great job, Harry, at the end of each meeting, not the one that responds to in the investor update with a thumbs up emoji, but who's the one that's really engaged and believes in you and that will burn their social capital and their time to catalyze around. Someone's got to catalyze it. It doesn't happen on its own unless you're crushing it.
Do you think VCs have shown up and made us proud in the harder times? Or do you think they've just reinforced the bad image of venture, if you're honest?
I think founders have shown the bad side of founders. I think founders became too entitled. And I think founders expected the next round would always come. Founders became very arrogant toward VCs, viewed them as fungible, put them on irresponsible schedules, didn't share proper diligence, abused the system, and they took advantage of the time. So that sounds very critical, right? I mean, it is critical, but both sides react poorly when the pendulum's on either side, right? When there's no money out there, VCs are pretty crappy. My first startup, it was terrible. I had a 5X participating preferred and a 2 million pre, and like I can't even tell you how bad the terms were in my story. And all the VCs would collude and they'd all talk and they'd negotiate the deals down together. That's a low point, okay? And a low point for founder behavior was 2021. It was abusive toward VCs. It was abusive. The Hopin story is abusive. I'll take 140 million out for myself. F you, VCs. That's right. I know a lot of folks think that's a hero story. I think it's abusive. And so
I'm going to go on that one. I think
it's abusive. I think it's abusive. I think it's unethical, and I would not have done it as a founder. I think it's unethical.
You have a choice to take that deal.
No.
It is.
If you are a founder, Harry, if you're a real founder, you have constituencies. You have your employees. You have your customers, and you have your investors. And you know where real founders put themselves on that list of three? Last. Last. And I know, and that's why what Hopin did was unethical. It damaged the company. That company needs that 120 million. It was ripping people off. You ripped off your investors. You probably ripped off your employees. I don't know how a tender offer happened, right? And it wasn't good for the customers. Anytime I see an employee, a founder, put themselves above, like by all means, oversubscribed round, whatever. Take care of yourself. But when you're above those, 0% chance it's going to be a success. Zero. That's why it's wrong.
Okay, let's roll with this. You have incredible revenue scaling. The brand of the company is insane. Fastest growing company in Europe, the darling of European tech, on the front page of everything. And it's a sole founder. He's got 50% of the company. And investors are battering down your door, begging you to take their money, begging you, not you forcing it on them. They are begging you. And then they say, hey, sell 10% and take 150 or 200 million off and buy yourself that cushion so you can think bigger than ever. So you can dream for the rest of your life in upside for Hopin, putting everyone else first. If you're a founder, you're going, I'm going from 50 to 40%. So actually not a huge difference. I've still got a huge amount in this company.
Very logical. Very logical.
And they're begging me to do it. Gosh, okay, sure, yeah. I don't think it's unethical. I think it's
unethical, but even if it's not unethical, I think it's telling because listen, I think that a tactical rule. I'll say that if you're putting everyone else first, which is not something 99.99% of the world will do. If you're putting the rest first, I think taking out more than 10 million is a bad sign, even in the hottest round. Most founders I know do not have a Bezos yacht yet. They are not buying $40 million homes in Miami. They're building their friggin' companies. You have to be a little bit humble for a long time or people won't work for you. If you're I got to find a better word, but if you're a douchey CEO, people don't want to work for you outside of pockets of Hollywood. Okay. So I find most CEOs, especially in B2B, live relatively humble lives, okay? So $10 million, let's be generous, let's call it after tax, okay? We'll let you take $10 million after tax of the company. That is enough to put a down payment on a decent home. That is enough to get a Model 3 performance. You don't even have to get the base one, okay? In fact, 2. And it is even enough, although it will be stressful, to put your kids in pretty good school. So all for it, the 10, the 50, and maybe it's a bit more in the hottest rounds. But then there's a point where you're saying, look, my stock is company's probably not worth this much. So I'm going to monetize it now. That is logical. And I would, if I'm in that situation again, I will sell my shares as a seed investor if I'm allowed. I would sell all of my shares, all of them, 100% of my shares in that situation, 100%, because I know he's not really going for it.
But often at that stage of investment, I'm not necessarily talking about Hopin, but just generally at that stage of company trajectory, 10 million isn't really what the investors are going for because they need to move more money. That's why they need to move 150 to get 3 or 4% at least.
I understand their goals, and they may be regretting some of those secondary deals because of the incentives they created. Incentives matter.
They do.
Right? The VCs are now living with the fact that, yes, the founders pushed things too hard, but the VCs were the enablers. They were the drug dealers.
This is my point.
They gave out the heroin or I don't know too much about drugs. I know whatever drugs people use today, they gave it out. They gave out these drugs. And I'm a founder and my growth has slowed and I have a 10, 50, 100, $200 million in the bank. I'm not going to kill myself, Harry. Okay, there's the founders that took out 50, 100, 150 million from companies that that aren't already, that the real issue is they didn't leave the planet, right? Listen, maybe I'll be criticized for hopping, but one thing that is clear is it didn't leave the planet. Okay. It's one thing if you're incredibly profitable and you take a dividend. Okay. Like we all know folks that we started this conversation. We talked about bootstrapped companies. There's a super set of folks that not only bootstrapped, but are generating lots of cash. And you know what they do, Harry? They quietly dividend themselves out 10 million, 20 million, 100 million a year. That's what they do with their surplus cash, right? The micro version of that was when instead of giving seed companies $1 million or $2 million, we gave them 10. And now they have 10 years of runway and they're just paying themselves salaries. That's the mini version of this, right? And so we see these big stories, but there's probably 2,000 startups that are run for salary right now. That was a combination of founder greed, not putting themselves, and these ones that are run for salary, you know where the founders sit in that stack of customers, investors, employees? The founders are definitely number one.
What happens to those companies? Because they do have long runways.
Yeah, I think some give the cash back, and I think some will remain a study in bubble economics that we are studying for years to come. Some will just keep running their companies. You know, if you raised one round and you gave up no board seats, I don't know how it works in the UK, but I don't think in the US you have any recourse as an investor, right? And you know, we briefly touched on that when we did the roundtable with Founder Collective. And remember, he said, look, if that frustrates you, you got to remember it's not your money. You gave it to them. It's not your money. And some of it will be wrongly used and some of it will be underdeployed and misdeployed, but it's not you can't get that. It's not your money to get back. And that was a good one. That was a quote, top 10 quote for me for the year too, is it's not your money. You think it's your money as a VC? This is a VC conceit. It's not. It's not your money. We act like it. The board meetings are structured like it's your money, right? But the lesson from 2021 is not your money.
What a lesson that is. I want to translate this to a forward-looking projective eye when we look forward to 2024. If we think about your home base first, SaaS early stage markets in 2024, what do you think?
I've been doing SaaS since 2005, and this is the first year I'm worried. And I'm not worried the fact that we're trading at 6x, but I'm kind of worried about that because we're in the third year of crummy public multiples. Like I am worried about public multiples. It's tough for investing. I am worried, just worried that the deceleration that we saw last year, that public SaaS companies growing at their slowest pace ever, I'm worried some of it may be permanent. I am worried that Gartner says there'll be $1 trillion in enterprise SaaS spending next year. Okay, $1 trillion, right? You could only spend so much of the US GDP or the global GDP on software. At some point, we are saturated with SaaS and software. At some point, it's not just that we want compound products or fewer vendors or this. It's just at some point, literally, software cannot keep growing faster than GDP forever, right? And we've had a run for 18 years in this, where software spend exceeded everything else. It just absorbed more and more of corporate budgets in a quest for efficiency and in a quest to not fall behind. If that doesn't come back, and we have finally reached maturity in SaaS, we can make money in venture, right? Because eventually a HubSpot may fade or a Salesforce may fade, but it takes a really long time. So it's going to be much harder to make money in venture if we have to wait for ServiceNow to fade away.
Doesn't the definition of software spend change though? When you think about the introduction of AI into so many of our workflows, into what it does for productivity and what that does for GDP, like software spend as a category itself almost
it may, but we have to, but for that to be true, I think that for me in my little bit of world, the contact center is where it's the most true. For to be truly true, you have to unlock budgets outside of IT because IT is only going to get so much budget, right? I mean, I asked Aaron Levy when I talked to him, when you talk with your biggest customers, what's their AI budget? He's like, their AI budget is zero. There's no AI line. Now, it may come out of a different area. It may come out of and functional groups may have budget, right? But the CIO's budget in the enterprise, the IT budget, it inflated so much the last couple of years and then it deflated last year, right? Where's this extra money going to come from? And I'm not saying the party's over. Gartner says it's not over. But I'm worried. I still don't fully. I know why some growth slowed this in 2023, but I feel like it slowed a lot with a really, really, really strong U.S. economy. Like the U.S. economy, yeah, we have some interest rates, blah, 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 ZERP, DERP, WERP, CLERP, but it's a good economy with good companies making lots of money. And we hit a train wreck in SaaS growth. So I'm worried. That's my worry for 2024 is that we've always bounced back these downturns. But I'm a part of me worries we may have seen some saturation in spend for the first time.
Bring that back to the SaaS early stage market. What does that mean?
I don't think this is why I struggled to give you the great growth investor answer. I don't think it's going to impact early stage much. I think there will always be wedges. There will always be new tools, new things that take advantage of technology. This has been true since the dawn of software. People will figure out new ways to build neat things at seed, and there will always be 100x opportunities for the next one that comes out of left field, right? That does something we didn't know about. We didn't know we needed Riverside. We're on Riverside right now, right? We didn't know podcasting would be big enough, right? But that could be 100x, right? So the beauty is that those will still exist. Whether there will be enough folks that can achieve $1 billion in revenue growing 20 or 30% or more, that's the bigger issue, right? Will there be enough? Because the real math and venture, we can talk about all these exits and stuff, but they're predicated on hitting $1 billion in revenue with real growth, right? That's sort of the terminal state of SaaS. And when I started doing all this, we didn't think it was possible. Now it's kind of commonplace. Like there's so many, forget it, growth has slowed, but there's so many that have crossed $1 billion. But $1 billion can't cross $1 billion. So, but I think the vibrancy of seed is here to stay. There's too many folks that made money. There's too many folks that enjoy investing. There are too many LPs that are still going to search for that alpha. And every year there's going to be 1,000x outcomes and multiple 100x outcomes. And so that's the fountain of youth. We're always going to be searching for the fountain of youth at seed. It's never going to end.
If we then move forward, SaaS late stage market.
I think it's tough. I think it's very, very tough. Here's what I think has really happened, Harry, and I think people think that there's an AI bubble in venture, right? And clearly, to some extent, there is, right? But then we just talked about the OpenAI numbers, and your jaw drops, right? Mm-hmm. People sort of just a few weeks ago made fun of Menlo and putting $1 billion into Anthropic, but if they're doing 200 and something million in 1 year, it doesn't seem like such a bad deal, does it? But my point is that what I think has changed permanently since 2021 is venture post-seed is perpetually going to be searching for decacorns. When I started, even when you started in this industry, we were searching for unicorns. We were all searching for unicorns. Box IPO'd at 800 million. HubSpot IPO'd at 800 million valuation. Shopify IPO'd at a $750 million valuation. We were searching for unicorns. And then when things got good, every unicorn was a decacorn, right? In the public markets and in the private markets, right? And I think we have now been wired that way. And as long as there are a steady stream of Stripes and Databricks and open APIs, there will be enough decacorns that venture is permanently decacorn hunters. And that's what I think we're going to see. And so
do you think there are enough decacorns though? You mentioned
I think there's enough to take the bets. I think there will be enough Stripes and Databricks and OpenAIs that some growth funds can do 3x net or more. And that will get the LPs to re-up, and that will rearm the decacorn hunters. But I don't think there's going to be unicorn hunters anymore. I think they're decacorn hunters. And you'll see some folks on 20VC and say, oh, we're very conservative and we're optimized around $818 million outcomes. But I don't think it's true. I think everyone is hunting for decacorns permanently. That has changed in venture. We're more realistic about how many there will be, right? And frankly, it's harder to believe that many will be decacorns, which makes it hard. But I think we are decacorn hunters forever, Series A and beyond. I think the industry has permanently changed, and it may be under discussed that we're decacorn hunters.
Do you think Stripe goes public in 24?
I don't. I mean, there's some inside information that I don't have, right? I think so. I think 2024 is the year of you might as well go public. I think, listen, because here's the thing, Harry, we will be in the third year of a multiple downturn. So you could be like 2022, oh my God, multiples fell 75% in 2022. That's not a good year to go public, is it? Multiples plummeted 25%. Okay, 2023 weird year, but Nasdaq rockin' year, right? Average public company up 40%. Top public companies up. HubSpot up 104%, right? Mongo up 112%. Shopify up 128% last year. It's like feeling good, except the IPOs were mediocre. Not they were great companies. Klaviyo, Arm, Instacart, A plus companies, but just good IPOs because the markets were tough, right? But 2024 is the third year. If you're a Stripe and there's nothing wrong with you, right? Other than the multiples, you call it a day. You're like, we're going public. If we're going public and we're going public at 3x ARR because of our margins or whatever, you just call it a day and you just get it done. And people stop caring. And it's time to grow up. It's time to move out of the house. It's time to get out of the basement, and you just do it. So I think people will give up on waiting for the markets to change and just do it.
Do you think Databricks will go out too?
People talk about that. And the only question I have is, based on what I've seen in the information and others, the losses are still significant. So no matter what everybody says about how exciting the top line growth is, it would make sense logically to wait a year so that you could gradually taper your losses and not be pressured, because every public company is so efficient today. If I were Databricks is one, based on what I know, I would wait. Everyone's saying they're going to go. Actually, I hear it from ex-employees and other people. They're going to go public, and people are excited, and maybe they will, and they can pull it off. But logically, I might burn more cash for a year. Like I don't know. I want to be under the public pressure to get efficient. I'd wait a year if I were Databricks so I can continue to capture share and grow like a weed.
Who else is in the just do it? It's time to grow up. Who else is in the category of just do it? It's time to grow up.
ServiceTitan may be the first one to go IPO of this group. ServiceTitan's jaw-droppingly good company. Right. Jaw-droppingly good, right?
Sell me this pen. Why is ServiceTitan such a good company, Jason?
ServiceTitan dominates a market. ServiceTitan's at over $500 million in revenue. Okay, it's cash flow positive, as I understand it. It's got 12,000 customers. And it does something which is magical, which is that it has very high NRR at a low ACV in a tough vertical market. It is SaaS for plumbers and air condition maintenance and other things, and it has triple-digit NRR in that market. It is very hard to have triple-digit NRRs in SMB with small deal sizes, right? And it ended last year at $460 million in revenue, probably. So today it's at $600 million in ARR, selling HVAC software and plumber software, growing 40 to 50%, cash flow neutral. I think it'll be the next one to IPO. Some people think it could be in Q1, but that's one where it's just time, right? And if it's whatever the valuations are, it doesn't matter whether it's worth at 600 million ARR growth rate, if it's worth 5 billion or 6 billion instead of 10 that they'd hoped. So what? It's time. This is a very mature, very well-run company, right?
According to data, $9.5 billion.
Yeah. So I think this is a great example. Great. Some of the best founders I've ever met, salt of the earth. They did it themselves. But let's assume they're at 600 million ARR, and valuations suck, and they go public, and they're worth 5 billion. That people would be throwing their shoes in 2021, but maybe in 2024, like it's fine. It's $5 billion, guys. It's pretty good that we did, kids. It's pretty good. It's time to go public. It's time maybe to do a little M&A with our stock. It's time to provide some liquidity with employees, right? It's just time to do the things. This company's 11 years old. It's time to IPO, right? And so but if the last round was at close to 10 billion, do I think they're worth 10 billion? It's possible they might get a Samsara-like multiple, right? But just if we're going to be a little bit tough on them and just say you're an average, the average multiple would say, hey, this is an A+ company that will price less than the last round. And I think everyone's over that. Yeah. Everyone's over the fact. I had a conversation with one of my LPs about a round that was at a great deal, but was below the last round. No one cared. They just, I felt guilty about it. Everyone's already internalized this. Everyone's already internalized that there may be price adjustments to these ultra late stage rounds in 2021, right?
Okay, so moving up from the company specific, do you stand by your position that the H2 2024 is when everyone goes, fuck it, we're going out?
Listen, these things are fluid, right? I felt pretty confident about the vibe check when we did it. if I had to give an honest answer today, I think it's going to happen, but it's going to be shifted 6 months. So I think it's going to happen in 2025 because it's getting late. It's already January, right? So if you're going to go public this year, you've already kicked it off, right? It doesn't mean you filed like a Service Titan allegedly has, but you've got the CFO in place. You've managed the numbers, and you got to be looking, 16, 18 quarters ahead to go public. And so I don't know that folks have come back from the New Year's Eve parties and are all ready to go public in the second half. I may have been optimistic. I think that the kind of dud IPOs, the great duds, like the Instacart, Arm, Klaviyo, which in 2021 would have been, your jaw would have dropped because these are A-plus companies. The fact that they didn't rock it sucked some energy out of everybody. Yeah. So logically it has to happen, but it may be shifted 6 months.
I want to talk about M&A quickly. Obviously, Figma didn't happen in the end. How do you see M&A in 2024?
There's a huge appetite for M&A. And I see it across my portfolio. There is a huge appetite for M&A. And it is natural because, as we talked about before, growth slowed for everyone in 2023, right? And what do you do? And people, when growth slowed, people played the first card, which was get more efficient, pause hiring, focus on the base, raise prices, raise prices, raise prices, raise prices. What's the next thing you can do here? You got two choices. You can build another product and try to get it to market like HubSpot did and wait 10 years to build HubSpot CRM into 700 million if you're great founders. But what's the easier thing to do? You got to buy something. You got to buy something. And I have seen lots of tire kicking across my portfolio in the last 6 months. A lot of it, not just from public companies, but a lot of it from ex-public companies that are acquired by PE. They're all looking to bolt stuff on. They're all looking to bolt stuff on north of 20 million in ARR that they can afford, which is the tough part of the conversation, that they can afford that can move the needle at some level, right? What will that translate into? I don't know. I think there will be lots of good M&A opportunities to bolt on in like the $100 to $400 million range next year. People are trying to do those deals. And then I think, the Wall Street Journal said this week that 2023 was a low point for PE investing for like 7 years or 8 years. It's got to come back next year, right? If inflation rates come down even a little, if interest rates come down even a little bit, PE gets much more attractive, right? It gets much more attractive. And if the IPO markets open even a little bit, it gets much more attractive. PE gets compressed when you can't see exits in 3 to 4 years, right? You got to at least sell to each other. At least Insight's got to sell to Vista, or someone's got to sell to somebody. But I see it picking up. On the Figma thing, listen, I'm not a total expert, but I have been a VP in a top tech company. And I know a lot of folks like Brian Halligan, we talked about, said that Figma thing will be like, it will create a chill on large M&A. It's not what I see happening. What I just think happening is there'll be huge appetite for M&A anyone can afford, but people will buy adjacent plays rather than directly competitive plays at scale. Maybe Adobe can't buy Figma, but maybe Google can. Maybe Google's the wrong example, right? But you will buy, maybe Twilio can still buy a Segment, right? Whether that was the best deal for them or not, it was not directly competitive. They tried to get into the CDP phase, right? These adjacent investments will happen, but folks will not be able to buy things. Well, Trump could change this too. But if we stay in our current administration, it may be hard for Adobe to buy Figma, but somebody else can. Microsoft probably can buy Figma. Someone else can buy them. Would Trump be better for M&A than the current environment? Boy, I try to stay away from politics, and I think VCs. You know what I learned from the SVB and the Figma is VCs try to claim they're these big macro folks, but they really care about their own pocketbooks. So is it better? Would Trump be better for VCs for M&A? Probably. Right? Every VC wants a Figma deal to go through, right? The Microsoft Activision deal barely went through, right? That was a huge headache. Other people would have quit and given up. Everybody wants this. It's hard to imagine that this is a top priority for the Trump administration. So I guess it's a positive, but be careful. And again, I try to stay out of politics. Be careful what you ask for. There's a lot of unintended consequences. Will Trump be better for carried interest? Will Trump be better for a qualified small business stock? Like, this is something that's under discussed. Like, who will revoke qualified small business stock in the US? That could be disastrous on many levels. Like, I don't know. All I know is Trump is not a friend of California because he can't get our votes. And so that part worries me. Trump dramatically raised our taxes in California and New York. everyone talks about how Trump cut taxes. He sure didn't in California or New York. All our taxes went up because we could no longer deduct our state taxes against our federal taxes. My taxes went up, 15% under Trump.
Will the return of SF come back in 2024? AI means SF is again the home of tech. Will that continue?
First of all, this got too dogmatic, this SF versus the rest of the world thing, right? And there's going to be, 400, taking this back to earlier in the conversation, how many YC companies are there a year? 400, 500?
Yeah, so along those lines.
Half are going to stay. And Gary's going to do this for a decade. That alone will be transformational to SF by, 2028. They're going to stay. Just like in the old days, Stanford kids stayed in Palo Alto. When I started in tech, it was downtown Palo Alto. It wasn't SF, okay? And why? Well, the kids would just go down university. Downtown Palo Alto is literally, you can walk to Stanford. That's where our SaaStr office is now. We gave up our SF office, but we have one in Palo Alto. It is wonderful. You literally walk down. It's so wonderful that the Google campus was built to copy downtown Palo Alto, as was the Facebook campus. They are both built to copy. Well, Google was built to copy Stanford, and Facebook's original campus was built to copy downtown Palo Alto. So and that's going to happen at YC, except they're either going to roll into Hayes Valley or they're going to roll into Mission Bay, and they're going to stay. You're going to stay. And so SF will never be what it was, but if I were a founder today, it'd be where I was.
I know. Listen, I love that, and I agree with you on the dogmatism, but I still love to ask the question. Venture funding, everyone says about the absolute cratering of venture funding. I think in a lot of cases, slightly skewed in terms of the data that they present.
Yeah.
Will venture funding return in some respects? Will it continue to be reduced? How do you predict venture funding in 2024? Will it be easier or harder for founders to raise?
VCs will deploy as much capital as the LPs will give them. Within reason, they will deploy it. If they can go back to market every 18 months and find a reasonable number of deals, that's what we learned in 2021. They'll go back to market every 12 months, every 18 months. What they learned the last year is sometimes you got to go back to market every 3 years or even 4 years for some funds, right? But VCs will find a way, but especially with SPVs and growth funds and opportunity funds, if allowed, they will deploy as much capital as the markets will absorb. So the real question is, the segment of, and you're the closest one, I should interview you. I'll ask you the question, because there are portions of the LP, there are segments of LPs that are actually not that impacted by the lack of liquidity the last 18 months. Okay, A lot of university endowments have sufficient liquidity. Some don't, but some don't care. A lot of family offices don't care. A lot of sovereign wealth funds don't care at all. Like, what are they going to do with the liquidity? They got to reinvest it anyway, right? But there is a subset that needs that got paralyzed, especially the folks that are deep into traditional PE, where they're used to getting that cash back and recycling it, and so it's almost two worlds in the LPs: folks under stress for capital commitments and under stress for liquidities, and folks that just don't care today.
And then I would add one final constituent, which is just net new LPs to the venture ecosystem.
Net new LPs, yeah,
which is incredibly significant when I look at, like it or not in terms of China, but Asian LPs more broadly speaking, who've never invested in venture but actually dramatically want to. The amount of family office Asian money is exorbitant and extraordinary. UAE is coming in on force. Europe has thousands of family offices with the most incredible liquidity reserves. They want tech and they want venture. They're a curtain business. They're a machinery business. They know, and they've got a child that says technology is where it's at. There is a universe of new LPs that is entering that I see every single day.
Yeah, no, it's hard. They may be fatiguing a subset of VCs by having gone back to market too often. So I think it's almost you ask, will venture be, it's almost a very quantitative question. I think if there's just enough pool, VCs will raise the fund and they'll deploy it. Like and I don't think 2024, it's not going to be worse, but we're not going to see the massive liquidity events maybe we'd hope for another year. And don't forget, even IPOs, the liquidity is very delayed, right? Maybe Figma was part cash, part stock, but still, if Figma had closed, they could have distributed the next day, right? An IPO could be 36 months from 6 months after it could be 4 years until LPs get their cash back. So I don't know I don't know that it's going to be dramatically better in 2024, but I don't think it's going to be worse, right? And the other thing that folks don't realize here, you probably have better data than I do. A lot of these huge pools of capital you're talking about, especially international, their annual returns are terrible. They're not at the Harvard or Yale or Stanford level. They're not buying like swaths of forests in Scandinavia and weird assets and only investing in the top venture funds. They're returning like 4 to 5% a year. A lot of these things, less. And sure, you could put it all in NASDAQ, right? Which has its issues. Like, and maybe that's what they should. But venture is a great alpha to very, very, very mediocre returns. And so that capital will always want to get a little bit to grease it a little bit, right? They're never going to put all of it into venture, right? But if they can get some of it ahead of 3 to 4% a year, it can move the needle a little bit.
That's also why your multi-billion-dollar funds sustain, which is like you're comparing them to 6-7% net, which they get traditionally, and you're offering them 11-12% net, which is a 4% bump. Okay, great.
Yeah, too many people at Twitter criticize these large fund models and say, hey, how can you do 8x on a large fund? That's not the point. The point is to beat the crummy returns, a lot of these massive pools of capital in the real world. It's like all of us. We all think most folks, their 401ks or their personal investments are sitting in cash at Wells Fargo earning 0.1%. They think they're so brilliant. Your real returns, your real honest returns, including cash and the years you got scared and the time you stayed out of the market, are much lower than what people claim.
I say that like two things are needed to raise funds successfully for venture managers is DPI, like cash back to your investors. That always works. And then differentiation. If you have a truly differentiated model that you can prove tangibly, I think there is still LPs that will allocate to you with enthusiasm and gusto.
Yeah, I mean, look, the reality is, I think that's true. All that's true. If you're earlier stage, it may be as simple as, do you have one Datadog? I think we talk about DPI is great, okay? But at the end of the day, DPI is in the past. If I'm a new LP, if I'm re-upping, I can't tell you how many LPs I talk. I mean, LP is a weird industry. I can't tell how many LPs I talk. And you talk to literally 100x more than I do, but they ask, hey, is Jason used to be good, or Harry's last fund looked good, or whatever, Founders Fund this, or but what about the future? Like, it's so this, and so even DPI, like, but if you had if you were the lead in Datadog or Stripe or whatever, if you had one true epic outcome, it was as true when I started as today. That carries you, because then people they believe you can do it again, right? That you have the secret sauce.
Right. We're going to do a quick fire, and I'm going to pepper you with a couple of statements. Number one, what have you changed your mind on in 2023?
I have changed my mind that there is any chance on planet Earth, any chance that a pretty good founder can produce good venture returns. I will never again invest. I will only invest in founders that are much better than me. I will never invest in pretty good founders, no matter what the traction is, no matter what the growth, no matter what it is. Maybe it works in consumer, they say. But now that our lemons have ripened, this was the title of my last LP report. So much great progress in the portfolio in our core positions, but the lemons have ripened. So I took every write-off in my last LP report there was. I just wrote it off to the max. Anything that wasn't good for my first time, I just wrote it. I aggressively put the red pen or whatever to it, because I had enough of good but not great founders, and all the ones that I had to take the red pencil to were good but not great.
Do you think enough GPs have taken the red pen to their portfolios and been open with their LPs?
No, I don't. But here's the thing, and again, everyone talks at big game. We're not allowed to mark up between rounds. See, if we were allowed to mark up between rounds, which a lot of PE firms can, and late stage folks do, right? They can mark up traditionally. It's a weird world. So like everyone's like, take your markdowns, and you should take your markdowns. But what about the markups? What about the ones that never raise again that are worth billions or whatever? We're not allowed to value up, are we? Maybe in the UK you can. In the US, you basically can't mark up between a round. No. So I think it's all a weird world. And I think that at some level, LPs have gotten over the Sony baloney valuations, and it's just show me the business. And if a GP doesn't mark down a given deal, they just don't. I mean, I don't know that it's as high drama issue as it was last year. I don't know that it matters. And I asked my own, and listen, you have a broader group of LPs, but I asked my own LPs, and they didn't carry their way that much.
What's the best investment advice you've received? I'm sure you've been given advice by many people. There's
no shortcuts. Just say no if you're not sure. It's all just, there's no shortcuts. Just say no if you're not sure. If you're not sure, just put more money into your winners. If you don't know in 20 minutes, don't do it. Everyone, if you don't know, if you're investing for other reasons, if you're investing because Harry's in the deal or Mamoon's in the deal, if you don't know in 20 minutes that this is one of the best founders you've ever met with, don't do the investment. It's too hard. It's too hard. We forgot in 2021 how hard this was. Now we remembered how hard it was, Harry. That's the only one thing we learned the last year. Even in 2022, it was so crazy that the knife, the falling off the cliff, we didn't even remember how hard it was because we were adapting. We were what? Slack was worth $27 billion when Salesforce bought it, and probably worth $2 billion today. Like what happened? Or $4 billion? Like we couldn't even comprehend the rate of change in 2022, right? So now in 2024, it's like, listen, if you don't invest in Dylan at Figma, you're not going to make any money. You're not going to make any money. You're not going to make any money. And so those are the regrets, all the good but not greats. And if I honestly, I just wrote my LP report on the ones that I took. That was the same answer to the three that I marked down to almost zero. Good but not great. Good but not great. Good but not great. Right. And then one was great but tired. Okay, that's a different learning, but that's a tougher one to get right. Right. Repeat founder that's great but got tired. That's an issue. I don't know about that bet, but
what's the learning on great but got tired?
You got to smell the urgency out of their pores. It's got to be like that Dharmesh Brian story from HubSpot where they're like, we had a decent outcome. I sold my last company, but like, I'm going for it. If you don't smell that urgency out of the pores, I think some repeat founders, especially if they weren't the CEO, like if they were the CTO or someone else, it was hard, but they kind of forget how hard it was, or they forget what happened. And you need the first time founder crazy level of urgency in a repeat founder. And when you have that, it's magical. But you just have to smell it across the Zoom or the Riverside, that urgency. It just has to reek. And I think this one deal I did with a founder I love, I've known him for a long time. There was a desire and an insight, but the urgency, it wasn't there, right?
Oh, I totally agree. My biggest meh deals are 5 on 25 with an exec out of a large company who's made a lot of money, but very comfortable in life, and just has no urgency. They've raised 5 million and they have $1 million in costs. They've probably got 5 years of runway, and it just moves slowly. And they're very diligent, and they work reasonably hard.
Yeah.
Never
you need
goes
maniacal anywhere. In this world. You need like a maniacal sense of urgency. And
dude, you said at the beginning the best of lessons learned from mistakes. What is the biggest mistake you made? I'm happy to share mine.
I think my biggest mistake I don't know how to be actionable on. I think about it constantly, right? Is I'm not a good nudge. The best investors are nudges. The classic Sequoia playbook, which literally happened to one of my portfolio companies a couple months ago, where they sit in the lobby and just wait, with the term sheet. Sequoia still does it. They did it 20 years ago. They did it with Talk to Us with me back in the day. They did it again 2 months ago. This classic playbook. Byron Dieter did it with me back in the day at Bessemer, of just sitting on your steps with the term sheet. That's one way to be a nudge, right?
Does that work? Because the founders that I meet are like, that's like forcing me into a marriage. I don't do that either, because I'm like, it's your free will. I don't want to impose myself unfairly.
I think about a couple really good deals. I mean, great companies, where, and this is what and I'm self-critical, where I didn't nudge my way into the deal like people do. You see VCs that are fucking nudges. They nudge their way. And you know what? Maybe, as I love him, maybe Mamoon's a nudge. I think he might be a nudge, and I think it might be part of his skills. Now, a nudge that you want on your team, right? And I mean this at a 10 out of 10. And I'm not saying I might be, if Mamoon listens to this earlier, I mean this with the most respect. I could be wrong. I think he's a good nudge. I remember meeting Parker Conrad early at the Zenefits day, and I bumped into Mamoon like the next week. He's like, yeah, they just raised a round, but I'm going to go over there and hang out with Parker and see if maybe there's some room in the round in Zenefits, right? And then he did it in Rippling, right? He waited, he did the thing. And so I don't mean that they're all nudgy, like sit in your lobby with a term sheet. There's good ways to do nudgies and dinners, but I'm not a nudge. I'll meet with the founder. I will try to help them for free. I will give them some advice. And I will say, if you want me, let me know. If you don't, let it go. And I think if I were a nudge, I would be much better investor.
What's the biggest deal you've lost because of not nudging?
I'm not critical of the ones that I didn't see. Those ones don't bother me at all. I'm only so smart. Like if I didn't see it, I didn't see it. But when I think about how could I have been a nudge? How could I have sat should I have sat? Like, should I have flown to London? Should I have done this? Should I have, and I tried a little nudgy experiment the other day just to learn if I'm a nudge, and it doesn't backfire. It never works. This founder who has a really great company, they tripled last year, right? And he keeps me on his investor updates, right? And so I asked him last week, hey, could I put in an extra $1 million into the last deal? He's like, no, I would love you to be my advisor. I'll give you options. I'll do all this. And you already get where I'm going. It's like, no, I'm going to try to be a nudge. Like I did want to invest, but I was also trying to be a nudge again. I'm like, I can't be an advisor. I'm overloaded. But I can, if I can do a minimum of $1 million, I can still help you. And I couldn't nudge my way into the deal. He wanted me, but I couldn't, as a VC, I couldn't nudge my way into the deal. This was just the other day. And so I keep trying that nudge experiment, and I'm no good at it. You got to know yourself, right?
Jason, are you a better investor today than you were when you started SaaStr as a fund?
No, I'm worse because I'm slower. And I'm worse because I take some things personally.
I do love you, dude. Like, everyone's like, no, I'm so much better. Like, I've learned this, this, and this. And like, they're just very aware that people listen. And you're like, no, I'm worse.
I'm worse, slower. And I gotta learn to be more. When I started investing, I'm like, hey, my job is to give you money and get out of the way. Now I care too much. And I think it's a negative.
Why do you take things personally? I thought you wouldn't give a shit as much. You're like, oh, fuck it, I'm old enough. No,
the problem, Harry, is there's only so many trips around the sun. And when I don't just invest, I should just invest. There are times when I've just invested, but if I invest a lot and I'm on the board and I've dedicated years of my life, for either the founder doesn't give it 100% or something is slightly off or does the wrong thing, I've given too much of my trips around the planet, and I should just be a financier. That should be whatever, you move on, right? Your job's to hunt another deal, and I think it's a failing. I think you shouldn't be too involved with portfolio companies. You have a portfolio. I shouldn't be an advisor. And to be blunt, every single investment I ever made, I've been the most truly helpful and knowledgeable person on the board. Sometimes I've had great operators, but I'm always the best, and that can backfire.
The only thing I'd say is the ability to concentrate capital across rounds is less obvious when you are a financier at arm's length. With the companies where I am like in it, involved, on board, I can shape rounds with founders. I can put a lot more money in. When I'm just told of a round by email, I can put more money in.
Maybe, but if you made an investment and you're not on the board and you got 4 investor updates in a row, they're growing 12% a month. You could send an email and you could go have a meeting with that founder and try to invest $20 million.
Of course, I could.
You don't have to be on the board or know them that well.
No, you absolutely could. That assumes you get investor updates, which is a separate conversation.
No, absolutely. The closer you are, the easier it is to do that. Though I think I've learned over the years that the big funds are pretty good at doing that even when they're not on the board. They're pretty good at tracking these deals. And I've seen several times over the last 14 months, when times have been tougher, I've had 2 investments that crossed from very good to breakout, right? And big funds that were not at the board meetings were, flies on honey or toast, and both of them raised 8 figures from big funds in 1 week. And in fact, I think those deals are the easiest deals to get done these days when you have that visibility, right? People are still a little bit risk averse. And I'd rather put 20 million of my fund into something where I have some visibility, right? That's top 2% growth than top 1% growth where I'm not sure, right? So, and I think founders should take good inside rounds very seriously now because of the reason you said. This is different than a bridge, but if one of your investors really wants to step up at a higher price, right? Just 6 times out of 10, it's a good thing in this market.
Jason, will we see a generation of VCs leave venture?
I don't think so. I think I've been investing long enough that most junior folks have gotten little to no carry. The carry they've gotten vests so long that they never make any money from it. I think a lot of the best up-and-coming investors that have something special, that are differentiated, that can do a deal, they got good deals done the last 18 months. People think that like there's bad vintages. There's only bad vintages because you overpaid. But every month there's a great startup born. Of every year of my life, there's a great startup born. And the best up-and-coming VCs found them. And the mediocre ones complained about the markets or this or that. And the best ones just were heat-seeking missiles and found them. And they're going to get promoted and they're not going to lose their jobs. And the other folks may lose their jobs when funds either literally contract in size or in essence contract by having longer fundraising cycles. That's still a contraction, isn't it?
Yeah.
And it's okay. I think there's more jobs in venture than there ever would. And if you thought it was easy, you're delusional. Maybe there is a generation that there definitely is a generation that thought it was easy. And it stemmed to solo GPs and new emerging managers too. Emerging managers for the last 4 years thought it was so much easier. Every emerging manager promised their LPs 8x net. 8x net. I remember talking to one who I loved. I loved this emerging manager, but all his initial investments were at 1x. Everything was at 1x for a variety of reasons. And he's going out promising 8x. And I'm like, you have a lot of charisma, but maybe tone it down just a little bit. But he was 100% sure he was going to do 8x in 2020, 2021, right? So
I definitely think a lot of people forget just how difficult it is to do, depending on fund size, but just generally at early stage, 3x net is still a fucking good fund.
It is. We mocked it, and people didn't understand the physics, and they didn't understand all of it. So I don't know. I think if 50% of the non-GPs lose their jobs because it's hard or whatever, I mean, that's probably the way it should be in venture. This is not like, you know what I learned in the beginning of venture, Harry? I remember when I worked at this third-party venture firm, I went to a huge LP meeting in New York. And we to raise the new fund, and we handed them a 100-page spiral-bound notebook about the fund, and they just flipped to the last page, and they just looked at the returns, which is what happens to USP, and all they asked was, are you tech or biotech? Or that's all they want to know, and they all looked at the number, and you're a number as a fund, and you're a number as a GP, and you're a number as a partner and an associate, right? And you're a number, and if you're in venture and you didn't put points on the board the last couple of years, you don't deserve to be in venture. It's okay. This is not a charity. This is not a best efforts kind of job. This is not senior marketing manager creating infographics. Venture is both rewarding and brutal. You got to put up the numbers. And that's why markups matter and interim numbers matter, because you got to put up the numbers, right? We can talk about DPI forever, but you can't wait your whole career until the DPI comes. You got to put up the numbers. And if half the non-GPs lose their job and 25% of the GPs because they didn't put up the numbers, that's good. Move on. There's a veneer of kindness on top of a ruthlessness in venture, which is you have to deliver slowly, but you do have to deliver. So let them go. What founders don't get about venture when they fundraise is they really don't understand what it means that venture is a business of outliers. And I can't tell you how many, I'm sure you get these emails every day. They're like, Harry, like my company's great. Last year was tough, but if we could just get a little more money, or like our growth is pretty good, but not great, or whatever, these endless things, they don't get that it's outliers, right? You got to get into these outliers. How will these new emerging managers get into outliers? All of this, and just pretty good companies going to the pretty good founders, they don't get you there. It's so hard. Outliers are bust.
My friend, final one. SaaStr in 2024. Where do you want to be at the end of 2024? When you look across the funds and the media and the events business, we have relatively similar businesses in terms of how we think about venture, especially. Where do you want the events business to be? Where do you want the media business to be? Where do you want the funds business to be? How do you think about your goals for 2024 on those components?
Okay, look, for investing, I'm hesitant to put a goal, but I would like, if I could, 2024 would be my fastest investment pace since 2014. That would be my goal. That would be a goal. I don't know if it can be achieved, but that would be the goal. I think now is the time, and I have the mental bandwidth and the clarity and the schedule. So I would like it to be the most prolific time for a variety of reasons as 2014. In terms of like community, it's a constant learning, right? Some of this is pretty niche-y. It would be great if marketing budgets reflated in later 2024. Right now for SaaStr, as a media business, it's kind of interesting. Basically, all of our revenues from big tech, right? And it's true of a lot of companies too, right? So like the unicorns have no money, or they have money but they're not deploying it. Big tech had a really good year, right? So it's great to have added sponsors and partners like Cisco and IBM and others that we did not have before, which is great. But we've lost a lot of unicorns, right? So it would be great for folks for marketing budgets to reflate a bit. That would just help us invest more in the community.
How much does SaaStr do revenue-wise, if you're able to say?
Like 27 million the year before.
What would it take to do 100 million?
To do 100 million would be pretty easy in quotes, pretty hard in practice. To do 100 million, you just need to do a little bit more of what Gartner and a few other people do, which is just to build on SaaStr as a marketplace where where buyers of software can connect with more CEOs. There's two reasons people sponsor or partner with folks, right? One is sort of, but for what we do, especially at the events level, you're creating a marketplace. If you think about it, you're creating a marketplace. At SaaStr Annual, we'll bring 12,000 people together, right? In London in June, for the next SaaStr Open 2024, we'll bring 3,500 people to London, right? And it's great. And about 40% will be CEOs, right? Which are a very difficult group to access, right? And so events are a headache and they're a lot of work and people get grouchy and marketers complain about the expense. But what you're really doing is creating an IRL marketplace where buyers and sellers come together, right? And you're facilitating these conversations and this marketplace. So at SaaStr today, we do it just by dint of having a community. We just bring people together, right? But if we aggressively did it the way Gartner's and others do it and we blew it up, the number of connections would, instead of being good, they would go up not just a little bit, they would go up like 10x, right? I lament that I'm not completely executing that plan today because the things that are like SaaStr on the events media side, the couple things that are most like us are at 100 million. So I consider myself in some ways a failure for having invested a lot in community and founders, but not as much monetizing it, because the two things that are closest to SaaStr are Money 2020 and Shop Talk and e-commerce, and they're both over 100 million. So one of the classic SaaStr posts, and I say this to founders at the end of the year, is like, you got to judge your growth not on just on an absolute basis, but compared to your competitors. So like, let's say you're a startup and you grew 100% last year. You're like, hooray, Harry, we doubled last year. But your bigger competitor grew 120. You're losing share, aren't you?
Yeah.
You think you're great, but if you don't compare yourself to competitors, you're not being honest. So SaaStr isn't really losing share. Our business keeps growing. But when I look at folks that started, Shop Talk started the same time. Money 2020 is much older, but got rebooted the same time. And they're 100 million, and they don't have community, and they don't have a blog, and they don't have all these other social aspects or 1 million followers, and they're at 100 million. You feel like you've underperformed, right? But on the other hand, the interesting thing is, we did it with 8, and they have hundreds and hundreds of people. So that's the interesting. The other interesting thing on this media community thing is you don't want to be a BuzzFeed. You don't want to need massive human capital to fuel these things, right? And you have a team at 20 VC, but you don't ultimately need 100 journalists to do what you're doing, right? That's what's so epic about a lot of the social media, right? So there's a trade-off. Like, would you rather be doing 27 million with 8 people or 100 million with 200 people? Actually, it's a complicated question, right?
There's also like the cost of content. Like, our content is very cheap to make. You can get on a call, we can put adverts in it, we can have partners, done deal. Investigative journalism, long form research. Jesus, it takes a lot of time, costs a lot of money. Not nearly as good. I totally agree with you there. Jason, I love our chats. Thank you so much for doing this. And you've been such a star for the first guest of 2024.
Happy New Year to everybody. Happy New Year to you, Harry.